Hello everyone, today with MarketXLS we're going to talk about the call ratio backspread strategy. MarketXLS is one of the top Excel-based investment research solutions for investors. In this video we'll be discussing what a call ratio backspread strategy is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. A call ratio backspread strategy is best implemented when you're expecting the price of the underlying asset to be bullish or range-bound. It is a two-leg strategy involving two option transactions. What we do in this strategy is that we go short on in the money and long on the out-of-the-money call option in a 1:2 ratio. In this strategy, the loss is capped and the potential profit can be unlimited. MarketXLS offers a template for this strategy. Here's an introduction page for the users to read, and here's the active template. The yellow cells have to be inputted by the user, so the stock ticker, strike prices, and the expiry date. On the right side, some upcoming expiry dates are available for reference. And for the purpose of this video, we'll be using Apple, expiry date as 11 June. The ITM strike price is 125. The OTM strike is 135 and the ratio taken is 1:2. Below in the table, you can also see what option contracts we've bought and sold and their respective bid and ask prices. The net cash inflow turns out to be $393. We've built the net credit strategy and received $393 upfront to enter into the trade, and this is reflected in the net cash flow section. MarketXLS has many templates just like the call ratio backspread one you see here, and it refreshes all the data when you click on Refresh All. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break-even. The maximum profit is unlimited and increases with a rise in stock prices from the OTM strike that we went long on. If the stock goes down, then we gain from the shorted call option. And the maximum loss is limited if the stock goes up nearby the bought call option strike. The profit is booked if the underlying asset's price stays below the strike price shorted, or the underlying asset's price stays above the strike price bought. This is a limited loss and a potentially unlimited profit strategy as also depicted in the payoff diagram. That is all for today. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.